We've done all our current assets. We're ready to move on to plant assets, natural resources, and intangibles. These are all the non-current assets. The book calls them plant assets. There's a lot of alternative names for that. Sometimes we call them long-term assets. Sometimes they're called long-lived assets, and I think that should be long-lived, but if people say long-lived, don't laugh at them. Then the funny one is we always called it PP&E before you had PPE having a whole different meaning in the last year than we used to. So again, if the accountants are talking about PPE, they're talking about something a little bit different. The general rule is we keep our plant assets at historical cost. That's just because we do. We talked about this in a prior video, but again, it's not at market value on our balance sheet. We never write it up to market value. The value of our plant assets are the value that we spent on them at the very beginning. But when we say historical cost, that's the cost to buy your building or your car. It includes anything you need to do to make it usable for your company. If I buy a truck and I have them put one of those, they wrap it to get that sign around the whole van, that would go into the cost. If you're buying a house, you might have to pay some commissions. If you're buying land, you might have to do a survey. You might have to clear some land. You can modify your building. Say you need to put up in a drive-up window. Any of those things that you have to do to make it usable for what you're going to use it for. You might have a perfectly good building that's good for a bank, but it's not good for a restaurant. Let's say I buy some land, I need to knock down a building, level the ground, and my point is to build a new office strip mall on it. If you've been up and down 157 at all, they're doing that all up and down that area. The cost of my land here is going to include the actual cost that I spent on it, plus what you spend to knock down the old one and grade the land, level the ground, sewers if you have to, do a survey, all that stuff goes into the cost of the land. Once you start building that new strip mall, that will go into the cost of the actual building itself. So then that goes to the land, and then stuff that happens after that would go into your building account. The general rule is your asset cost equals everything to make the asset usable. But let's say we're going to buy land, it has a building on it, we spend $500,000. We have appraisal done, and they say, the land is in a really good location, so we got a bargain because the land itself would be about $600,000, and the building was appraised at $200,000. So we have to remove some trees, we have to grade the land, and then we spend $100,000 to modify the building, and then we put in a parking lot with some lights. And so for those of you in the Edwardsville area, I don't know if you noticed that XO Spa nightclub. I don't know what goes on in there because there's always a lot of cars. But it used to be a little restaurant, and they left kind of the building, but they modified it so much you never even know. The dogs are going crazy today. They were quiet right up until I hit the record button. So what do? The first thing we have to do is split out the building and the land. We bought it all for one low price. I'm going to do something called prorating. That just means take the percentage of the value of each one and divide that $500,000 based on that percentage. And this is something we'll do off and on through this course. And once you get to the managerial, you do it a lot. Our market values, the land was worth $600,000 and the building was worth $200,000. You take those two and add them together. And then by prorating, you take 6/8 and 2/8, and that's the way you decide how you're going to do it. So you take this one divided by the total, this one divided by the total. And what we're trying to divvy up is at 500,000. So our cost that we're going to say the land was worth was 375. We're going to say the building is worth 125. And when we total up, that better come up to 500 or I'm messed up. This is going to be our land, and this is going to be our building. So I'm going to do just a little T account just to show what I'm going to do then. For my land, I'm going to start that out at 375. But it said I removed some trees and I graded it. That just means take it flatter. So there's going to be another 25,000 I'm going to stick in that account. So my land is actually going to get valued at 400. My building, I'm going to start out at 125. Then I needed to modify it to make it worthwhile for my business. I'm going to put in another 100,000. So that's going to be valued at 225. And then I've got this parking lot. We usually have a whole separate account for all that outdoor stuff. You could actually call it parking lots, but land improvements is a more generalized name than parking lot. So that's going to be at 50,000. And that distinction is important because we'll learn a little bit. Land, you don't depreciate. And these two you want to separate out because they're going to have different depreciation lives and significantly different. Buildings we usually think last like 40 years. A parking lot, they might last 4 or 5 years. Some parking lots I think go 10, 20 years. Things that are really very different usually make different accounts. So then this question that I just moved down here, when does depreciation begin? And remember, we throw in everything that makes something usable, gives you kind of hint on when you're going to start your depreciation. It's when that asset is used. If you're doing a store, the day you open your doors is the day you start depreciating. The general rule is, again, we're going to keep our plant asset account at historical cost. We don't ever mess with that. Just for some reason, we kind of like to know how much we spent for that asset. We are going to depreciate it, but we're going to depreciate it and kind of hold that depreciation in that contra account called accumulated depreciation, so that our asset value minus our accumulated depreciation gives us our net value, which we'll often call the book value, and sometimes people will call it a carrying value. All names for the same thing. That's the original cost minus that accumulated depreciation gives you the book value. Once you do this, don't mess with it. Plant assets, we've got a whole bunch of them. Land, the key to that is you don't depreciate land. You go back to, I guess, the old farming days when land never loses value, and it very seldom does. It's at least always there. A building will fall down, the land will still be there. The other kinds that we do depreciate, any of those big things that aren't current. So buildings, parking lots, equipment, automobiles, furniture and fixtures, computers, any of that other stuff that you don't expect to use up in a year. For each of those, it kind of works like accounts receivable. We'll have a control account. We'll have an account called buildings. We'll have an account called equipment. Again, parking lot, we might call land hold improvements to be a little fancy. But each one of those, especially if they have very different lives, will have a specific account in the general ledger. Like we had in the accounts receivable, we also have to have a subsidiary which will list each asset, so each computer, each building, and tell us when we bought it, depreciation. If you look around, if you go into most office buildings, if you go into the university, every chair, every table usually has a little sticker or something that goes to that subsidiary. So when you sell that particular computer, it comes off the company's books. The first entry here then is one we've done already. On January 1, you buy equipment for cash. You estimate it will last 4 years. We get equipment, we pay cash for $60,000. And that's what we did back in chapter 2, I guess it was. And then when we did our adjusting journal entries in chapter 3, we had to figure out it's going to last us 4 years. It's $15,000 per year. We never messed with equipment. We made that special entry for depreciation expense and accumulated depreciation. Always those two accounts. Don't overthink it. We would do that each year for 4 years. And that's what we did back in chapter 3, I guess. To show that on the balance sheet, again, we would show equipment for the 60. You take out your accumulated depreciation of 15. So in that first year, you would show your equipment net of 45. And then the next year you'd add 15, so that the net would be 30, and then the net would be 15, and then the net would be 0. Your adjusting journal entry is always depreciation expense and accumulated depreciation. That's obviously an expense account. It goes on your income statement. That's your contra asset account, and that goes on your balance sheet. Contra asset means it's an asset account, but it has a credit balance. Depreciation expense is not any way you use it when you're just chit-chatting with friends. I'm sure you talked about depreciation expense all the time with your friends. It is not related to market value. Normally, you think about it, a decline in market value. It has nothing to do with when you drive your car off the lot, it depreciates by 30%. That's not what it is. All it is a systematic way to expense the asset cost over its useful life. That's all it is. We come up with some way that seems reasonable so we can do the little matching thing to match the cost to the revenue generated. So what that means when we see our assets on our financial statements, that is not the market value of the assets of the company. The computation is fairly easy, just something systematic. But there's some terms we use, useful life. Remember in the last chapter we talked about, there's lots of estimates in our financial statements, and this is one. This is an estimate of how long, and it's not even how long the asset will last, but how long you'll use the asset. The residual value is when you're done with it, how much do you estimate you can sell it for? And we've got an estimate here, we've got an estimate here. Now in real life, what we'll do is we'll come up with a policy for this useful life, and usually for your salvage value as well. And that's what makes it systematic. Most companies will say, we're going to depreciate computers over 5 years, cars over 8 years. Whatever we think is the average for our company, that's how we set that. And then we use it consistently throughout the company to expense things over the average useful life. That's all we're trying to do. Going back to our example, we're going to use that same truck. I think I switched it to 5 years here. Then we're going to sell it for $18,000. For straight line depreciation, all we do is we take the $60,000, we subtract out our $18,000 salvage value, gives us $42,000. Call that our depreciable, and I'm sure I'm not spelling this right, amount. That's how much we're going to depreciate on it. We're going to take that times our number of years. I changed that to 5 so the numbers come out. So 42 divided by 5 is 8,400 per year. Copy that over here, 8,400 per year. Got this little table, and I've also put out on Blackboard the solution to this, so if yours gets real sloppy, it's okay. So the truck is going to be valued at the 60,000, not the depreciable value, the original cost. That asset account stays at that original cost forever and ever and always. Just put that in there across the board. This 8,400, I'll make the journal entry on 12/31 of every year. I'll go depreciation expense and accumulated depreciation. I don't mind if you do that. Just make sure that looks like a D and not a P. It's going to be for 8,400 per year. Which one of accounts do we close? Remember, the expense account we close every year. So that's going to start fresh every year and show 8,400 of expense. The accumulated depreciation, we don't close. It's an asset account. This is going to grow every period. In the first year, I'll subtract out 8,400, and that will give me a net value. Sometimes we call this the book value. Sometimes people call this the carrying value. All names for the same thing. This is going to be 60 minus the 84, or 51,600. Then we don't close this. So the next year I make this journal entry, and I will add another 84 to that. 84 plus 84 is 16,800. My book value better go down or I'm doing something wrong. This is 43,200. Another way to get this is this minus 8,400 should give me that. Add another 8,400 to this, gives me 25,200. And I'm going to go across, otherwise I'm going to screw this up here. 33,600 and plus another 8,400 is 42,000. Then doing my subtraction, 43,200, 34,800. Again, this will be on Blackboard. This should make perfect sense when you get to here, because how much should we have depreciated? We should have depreciated 42,000. Because that's our 60 minus our 18. So that's how much our total depreciation is. And the 18,000 is the salvage value. So we made this one easy. We bought it on January 1. Very seldom do you buy everything on January 1. On this next one, we're going to say, what if we purchased it on May 1 rather than January 1? All that happens is that first year, you don't own it for a full year. We have all of May, June, July, August, September, October, November, December. So I've got 8 months in 2021. I know the amount since I've already done the calculation. Still go ahead and you take your 60,000 minus the 18, but we have 8,400 per year. We only have it 8 out of 12 months. So in that first year, we only do 5,600 for our adjusting journal entry. We're still going to do depreciation expense and accumulated depreciation, but just for 5,600 in 2021. After that, we're back to a year. I'm going to go ahead and put this all the way across so I don't mess it up. Make sure you always put the original cost, not the 42,000 after the salvage value. My accumulated depreciation that first year then is 5,600. But after that, it's the 8,400 every period. Let me go ahead and subtract this, 54,400. To get to this one, the difference is going to be 8,400 because in 2022, I'm going to book a full year. 56 plus 84 is 14,000. This is 46,000. I just copy these over. 22,400, 8,400 more. 30,800 plus 84 plus another 84 is 39,200. And then I'm going to wait. And I'm just going to subtract these. The parentheses are a nice way, instead of using a minus sign, because a minus sign, they're hard to see. Parentheses are the way we subtract. 46, 37, 600. Again, these better keep getting littler. I've done something wrong. And notice I've got 1, 2, 3, 4, 5. I got a 6th year here because that's where those extra 4 months will come into play. In 2026, I've got 8,400. I've got January, February, March, April. I can do 4 months. This plus this better equal 12. That is a measly 2,800. 56 plus 28 better equal 84. Good, 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 good. This is 2,800 plus this 42,000, which seems right because between these two, the very end, I better have expensed a total of 42, and I have an $18,000 salvage value. Straight line, that's what we've done so far. There's actually another method in your book called double declining balance. We're not going to do that. Another way to do it, again, we just need some systematic way. We can base it on units of production. Here we're going to estimate some measure of usage. We do this a lot with equipment. Let's say I'm Anheuser-Busch and I have bottling equipment. I might do it based on the number of cases of Bud Light that machine produced that particular period. Since we're using a truck here, we can use the number of miles driven. So rather than just saying we're going to do it evenly, we're going to estimate how many miles we're going to use. So it's just a different way. It seems like a little more fair way to do it, maybe. It does a little bit of better matching. But again, all I'm trying to do is expense that thing over the life. If this one takes 10 minutes longer than straight line, probably not worth the time and effort. All of these are estimates. Total those down. If I did this right, this is 200,000. Then to figure depreciation, we're going to do that prorating again. Remember the prorating, you take each one, divide it by the total, multiply it by whatever it is you're trying to divvy up. 10 over 200,000. 20 over 200, that's 10%. 60 over 200, you're just dividing by 2. 30%. 80 is 40%. 30 is 15%. And if you do these percentages, make sure when you're done, you come down to 100%. Then you want to multiply this by what you're trying to divide, just like we did for the building and the land. And just remember what we're trying to divide between them. I've got that 60,000 minus my 18,000 salvage value. It's 42,000 that I'm trying to divide. 42,000 all the way down. Really easy in Excel, kind of a pain here. But your expense then is going to be 2,100 in the first year, 4,200 in the second year. And again, kind of eyeball it. This should be twice that. 12,600, 16,800, 6,300. That should be more than 10%, but less than 30%. So again, kind of look at it. And then when you're done, make sure you total down. And if you don't come up with 42, you've lost a decimal place somewhere along the way. Doesn't make any difference. We'll end up expensing a total of 42,000. And we'll end up with that book value of 18, which is your salvage value. You can freeze that if you want to copy those. So the last two things I want to talk about on depreciation is depreciation is special. And I guess especially for you finance people, it's one of the few that is a non-cash expense. And if you think about our truck, you spent the cash for the truck when you bought it. But now you just are expensing it. What that means is a lot of times we don't hold you accountable. Let's say you're the store manager of the Target You don't want to be held accountable for the depreciation on that building because you didn't have anything to do with it. And so for a lot of decisions, you often ignore depreciation for decisions. When we look at our net income, the depreciation expense is included in net income, but again, often it's ignored. So you usually have to back that out before you make decisions. We do get to deduct depreciation on our taxes. So there's tax benefits to depreciation. However, they have a special method for the IRS. You wouldn't use straight line depreciation. You don't really use units of production. They've got a whole different way to do it, but it's still a way to write it off. So I'm going to take a break there and we'll talk about buying and selling assets in a separate video.